history's taught us anything, it's the only constant in life is change. Over the course of the last century alone, there's been a litany of challenges, numerous disasters. All of them have one thing in common. They've all passed. Some months from now, and it's going to be impossible to predict the timeline. It could be 6 months, could be 12 months, could be a year or more. The current situation we face with the COVID-19, that's also going to have passed. Just as with the bushfires, we're going to be left with a wake of debris, destruction, and we don't want to take it lightly, but it will pass. And as property investors, another area of constant change seems to be the world of finance, the world of banking, the world of lending. So to better understand how the coronavirus pandemic is going to affect your borrowing capacity and what you should do if you find yourself in financial stress, either because you've lost your job or maybe some of your property income reduces because your tenants can't pay you, I'm looking forward to this chat with leading finance strategist Andrew Mirams, Director of Intuitive Finance. Welcome, Andrew.
Hi, Michael. How are you in these very interesting times?
Well, we are socially distanced, aren't we? You're in your office. I'm in my home office at the moment, which is good. So I'd like to ask you some common questions because a lot of people are very nervous and it's understandable. I hate using the word everyone else has used, but they are unprecedented times. But recently, both our Prime Minister and the Reserve Bank Governor, Philip Lowe, have both used the same word, bridge. They said we need to build a bridge between where we are now and where we want to be in the future, because at some point in the future, the virus will be contained. Our financial markets, our property markets will return to normal. But it actually seems to me, Andrew, that our banking system is a critical part of this bridge. So let me ask you, are our banks open for business?
Yes, they are. I think the thing to understand, Michael, is even though this pandemic has brought things to the head, the banks are always very willing to deal with people in trying circumstances. That hasn't changed. And so what we've seen is they've come to the forefront with the measures that are available to consumers in everyday life, but also in this unprecedented times, repayment holidays and helping businesses try to survive through their cash flows, and investors and anyone with a home or an investment loan or any loan at all, they are there to help.
Well, it looks like the banks have been given a lifeline. There's been a $90 billion lifeline provided to them to get out there, to lend money, to stimulate the economy. And it seems to be at a really, really cheap interest rate. Now, I know many investors who've been trying to borrow lately have found the tighter credit policies, the responsible lending situation we're in at the moment, they found it harder to borrow. But Andrew, from what I'm reading, it seems that our banker regulators, APRA and ASIC, they've taken a more common sense approach in these uncertain times. They're actually allowing the banks to lend a bit more freely at the moment.
Yes, they are. I think it would be naive to think that we're going to get back to where we were, but they are open for business. We've had settlements every day this week. The banks are open for business. We've still got loan applications going in and they're being approved as normal. Now, I think what we might see in the near term, and this is moving very rapidly as well, the updates and the things that are changing, but we might see that if people are in any of the affected industries, they might have their income not allowed because of the uncertainty. If your income and your job is secure, the banks are open for business. And to be perfectly honest, Michael, we need the banks to be open for business. If the banking system shuts down, then the ramifications and I guess the knock-on and the domino effect of that would be far more wide-reaching than what people, I think, give it credit for.
Well, I think we've come into this terrible crisis in a much better situation with our banking system than we did the global financial crisis in 2008, 2009. We have gone through this period of more responsible lending. We've gone through a period where the banks have capitalised a bit better, and now the Reserve Bank has given them a lifeline. So we're very fortunate that the government, I think, has learned from the past also. It's not wanting to tighten credit. I remember in the past, there just wasn't liquidity in the system, but they're not going to let that happen this time, Andrew.
No, I agree. And they need to keep things moving. And I saw a really interesting statistic the other day. After the crash in 29 and then the depression, when the stimulus packages were brought in, so the crash happened in 1929, it wasn't until 1933 Now, 4 years later, now that's way too late. So all of our banks and all of our governments around the world, not just Australia, are being as proactive as they can. You know, there's lots of positives, and I think we need to talk about that. We're still getting loan applications in every day. We're still getting approvals every day, and we're still getting settlements every day.
So, Andrew, let's have a talk about the options available if you run into financial difficulty. You already mentioned one. Some people, if they've set themselves up correctly, and I know you set up your clients and our clients that way, they have an offset account or a redraw facility. What should those clients do?
Well, the whole purpose of having a buffer is in for unprecedented times, is for when you need it the most. So if your tenants leave and things like that, then the buffer is there for that reason. And we've spoken about it might be for a week, a month, a year. Well, let's hope it's not the longer term. But that's the whole point of having a buffer, having redraw, having offset accounts, having a line of credit. It's there for these times.
Well, looking at our property markets, I feel secure in the long term. I know we're going to get through this. And I know our property markets are underpinned by the fact that 70% of people in them are owner occupiers, and they're not going to give up their houses, and the banks aren't going to take away their homes. I know a lot of people who've got mortgages are actually ahead in their payments with their mortgages as well. Does this give them the opportunity to reduce their payments now with the banks?
So anyone that's been paying and taking advantage of as the lower rates have been coming down and they've been putting extra money in or things like that, you can do a few things. You can continue, if your job's secure, you continue to take advantage of the low interest rate environment and repay your debt quicker. You can reduce your repayments back to the bare minimum if that's what you want to manage your cash flow. And then if you are really well advanced, you can do one of two things. You can either stop your repayments or redraw those repayments and allow then that redraw to help you with your repayments and your cash flow management in the short term.
Now, what about those people who aren't in that position where they aren't ahead in their payments? How do they go about reducing their payments or pausing their payments for a while?
And this will be where a lot of people are in, where they've had interest-only loans or they've maxed out their portfolio. They might have a buffer, but they might have some things. They might have tenants that are coming to them saying, we've lost our job and we can't repay. All the banks are open and really willing to help Australians through in this time. So they can do what they call a repayment holiday or repayment pause. Now, it's not freezing your repayments. It's not that you won't ever pay them. They're deferring them. And I think that terminology is really important to understand. So you still will be charged interest. You just won't have to pay that interest today. And you'll get a repayment holiday for 3 to 6 months or as long as you need to get through. You need to meet the hardship test. That's the other thing. Like if you've got hundreds of thousands sitting idle in your offset account, you don't meet the hardship. Hardship is if you cannot meet your repayments. Hardship is if you've lost your job and you have no resources to draw on. So that's what hardship is. You still need to meet the hardship criteria with all the lenders, but then they will happily suspend your repayments, defer them, and it'll go on to a later date.
Now, does this apply to owner-occupiers as well as property investors, Andrew?
It's for every person that has a loan. So if you only have one loan, it's an investment loan and you can't afford to repay, it does impact you. Every single bank, Michael, as I want everyone to understand, has a slightly different policy. They have a slightly different system. They have a slightly different way of doing it. They are there. It's for all lending, other than at this stage we can work out on lines of credit, which have a cap limit or like a credit card and things like that. But home investment loans, even fixed rate loans.
Rate cuts have been announced. In the last month, there have been two. Are they banks passing it on to ordinary home owners or investors?
So the first cut that came through at early March, all the lenders have pretty much passed on the 0.25% of that. Some of them have taken their time to pass it on. With the emergency cut that was announced, not many of the lenders have passed those through. Most of them have passed them through in different formats, maybe to small business and trying to help small business survive, and they've done some rate cuts there. There's only a couple of lenders, and in fact, a couple of our non-bank lenders and that securitise money offshore in a different way, they've actually had to put rates up because of the cost of their money.
Now, we've spoken about people who are in a little bit of financial problem, but some of our clients and the property investors are not in that position. Is this a good time to go back to the banks and just refinance your current positions?
For the last probably year or 2 years even, banks' inflows and banks' writings of mortgages have been significantly lower. And they now understand it's easier to keep the loans that they have rather than trying to get new business. So yeah, it's a great time. In fact, we're doing repricings on all of our clients all the time, because when you've got this stressful, moment in time, the last thing they want to be doing is heaps of paperwork and things like that if they don't have to. So the first thing we do, we'll do a repricing at their current lenders, and we're getting some really good results. Then once we've got that and we've got the information advice on that and they're still not satisfied, then we can look at refinancing with or to an external lender.
Now, for those people who are going to ask for assistance from the bank, they're going to ask for a pause or a delay or a cutback in their payments. Is that going to affect their credit rating? Is that going to cause troubles next year when they're looking for a loan when the world moves on?
The really good news is deferring your repayments in these times will have no impact on your credit worthiness or your credit file. It's an emergency need in time, and that's how it's being viewed by all the lenders, all the credit providers.
That's really good news. And I think the other good news is that we live in a fantastic country in currently very challenging times, but this too shall pass. You and I have been around long enough to have lived through recessions, downturns, crises. It's actually a bit like a terrorist attack rather than a war. We're not damaging our infrastructure. So the suggestion is, with all these financial stimuli, it won't be as bad a downturn. As long as the government, once we come through the other end, keeps stimulating things, that's when we're going to need stimulus as well to grease the wheels of industry and get us going. But I think it's a great time, and I know a lot of our clients are doing it, getting themselves set for the next stage. So no, maybe you can't go to an auction this weekend, maybe you can't go to an open for inspection, but those who have their finance ready and pre-approved, because you and I have been through this, after every stock market crash, after every downturn like this, the flight to quality of residential real estate creates a property boom, Andrew.
I wish you'd stop reminding people of our ages, Michael. I think the grey hair and the no hair is reminder enough. But yes, you're right. Like, it's every other cycle. And we've spoken many times about cycles. This is a cycle. It's a jolt to the system, and it's been a significant jolt. But the GFC was as well, and we go back to all those times before, and again with 9/11 and certain things that happen in the world that we just can't physically forecast. What we do see is the world just normalizes. Humans, I was going to say Australians, but humans in general are incredibly resilient. We will find a way to get through this. And I agree, for those that are well positioned and well set up, there's going to be some really good opportunities for the long term, Michael.
Sure. And the opportunities aren't going to take advantage of people, but the opportunities are going to arise there because there will be some discretionary people, buyers and sellers, who step out of the market, but there are always people who do have to sell houses because they've got married, they've got divorced, they've got kids, they've got to move, and there's other people who need to buy. So while the real estate market will close, or almost close for a short period of time, it's got to keep moving again. And the government recognises that.
The facts are that everyone has to live somewhere. So whether you're a tenant or owner-occupier, people have to live somewhere. And the fundamentals of Australia haven't really changed. We're just going through a health crisis that has got the potential to cause an economic crisis. And I think all the leaders of our country are fundamentally doing a really good job at the moment in trying to protect Australians as much as they can. Life will normalise. It will get back to normal, and the opportunities will be there. And the long-term investors, because you're not investing for the next 6 months or 3 months, you're investing for the next 10 or 20 or 30 years. And the opportunities will there, and we'll look back like every other graph and every other event over the journey of time and say, gee, well, 2020 was a real challenge, but now look where we are.
So the banks are open for business. If you're in trouble, ask. Don't try and sort it out on your own. And if you're in the good position, take advantage of the opportunity to set yourself up with the right finance structures, the right ownership structures, so that when the timing is right, with the right advice, you'll be able to own the sort of property at a price that cheaper than you would have had to pay a few months ago, and probably cheaper than you're going to have to pay at the end of the year when the surge hits us. Thanks for your time, Andrew.
Pleasure, Michael. Thank you.